Hello and welcome to Dukascopy TV. I'm Natalie MacDonald bringing you another exclusive interview. On the phone with me now to discuss today's RBA Meeting Minutes is Tony Morris from ANZ Sydney. Tony, today's RBA Meeting Minutes were expected to hold a dovish tone. Was this the case?
I suppose you'd have to expect that any time the central bank cuts interest rates, they're going to provide some justification for that. It's certainly the case. I think, if anything, the market took a particular phrase in the minutes today to heart when it was revealed that the bank had basically decided it was quite a close call, but they went ahead and cut rates anyway. I suppose you could make the conclusion there that it was quite a close call, in which case the hurdle to further easing might be relatively high. However, I think there's enough in the minutes to suggest that the bank will retain relatively strong easing bias going into next year. After all, they did decide to go ahead and cut rates because the outlook on growth and the labour market remained relatively soft. That was the main point that I think the market took in its stride. But I think you can make a more general point here about the RBA. And whilst the international outlook seems to have improved somewhat, it did make the case that the Eurozone and Japan remained in recession. I think a major point here is for the RBA, they're going to be, I suppose, reluctant easers going forward, and they're going to be relatively reactive to data as it comes in.
ANZ has stated that you now expect a further 1 percentage point cut in the cash rate over the course of 2013, in spite of the cut we saw 2 weeks ago to a crisis level 3%. What are the drivers behind this forecast? And more importantly, did today's meeting minutes provide further confirmation of this expectation?
Yes, well, secondly, first, there was nothing in there that would change our view. I think the major points that we'd make around the RBA at the moment, whilst the cash rates are at post-Lehman crisis low, it's the effective interest rates across the economy in terms of mortgages and borrowing rates for a lot of borrowers across the economy remain still much higher than they were after the Lehman crisis. That's due to the higher cost of credit. So one of the arguments here is that the RBA will have to take interest rates to much lower levels to have the same impetus. Clearly, we're not in a crisis level. A very interesting aspect to the ANZ forecast of this further 1% call is that we still expect the economy to do reasonably well. I think these rate cuts, the main outcome of which will stop the unemployment rate rising too quickly. But the main drivers behind it, we've already seen quite a big cut to the expected capital expenditure profile across the economy, that the peak is lower and sooner than the Reserve Bank expected, and they've already highlighted they expect to see an offsetting pickup in domestic construction activity. We are definitely not yet seeing that, even though there's some early signs of it. One of the main points that we'd make is that the labour market forward indicators, such as the job ad series ANZ puts together and other companies as well, they've decelerated quite sharply over the last 4 months, particularly in the mining states of Western Australia and Queensland. And I think that expectations for the Reserve Bank of modest employment growth might be still overstating it somewhat. GDP data, growth overall over the last half a year has come in below trend, and also forward indicators such as the NAB business survey suggest that there's no change to that. One of the key aspects, though, is something that the Reserve Bank didn't discuss today, is that's the strength of the Aussie dollar against the US dollar. We're trading at 105 now. As a result of quantitative easing around the world, not just in the US but elsewhere, such as Japan, for example, which is driving up the value of the Australian dollar because our interest rates relative to the rest of the world remain relatively high. It seems like the rest of the world has zero or very low interest rates, and we have more normal interest rates. So I think that further currency strength will, in a way, force the RBA to cut rates going forward.
So if we look ahead, what events will the Australian markets now be concentrating on as a litmus test for the Australian economy?
Yes, I thought the last big international event has been the Japanese election. We'll get a Bank of Japan meeting later this week. We're obviously watching what's happening in the US with the fiscal issues there. It seems to be impacting. But from a domestic point of view, the Reserve Bank of Australia doesn't have a meeting in January. It's our summer period, so they take a break in January. There are two main indicators to watch out for in January. The first will be on the labour market in mid-January. We get an update on December unemployment rate in mid-January, and then at the end of January we get our quarterly inflation data. We've already been hearing that wages have been easing in line with the weakening in labour demand. That's positive for the inflation outlook. The high Australian dollar will be bearing down on imported inflation as well. With those weaker wages costs, if we do get a soft CPI number, I think that removes another constraint for the RBA to consider further interest rate move. Now, the RBA meets again at the beginning of February. At the moment, the market is sort of seeing a 50-50 chance of another 25 basis points cut. We are going for a cut, another further 25 basis points at that February meeting. But depending on how that data pans out in January, that might have an impact. We're expecting some weaker numbers there. That's why we've penciled in another rate cut from the RBA in February.
Thanks very much, Tony. That's all for now, but I'll be back tomorrow with an Asia Pacific themed Targets in Focus interview. Until then, goodbye.